Well, how's it going, friends and family? My name is Amos, and by the way, I'm a new dad, first-time father to a little baby girl. Dude, last night from like 10 p.m. until 7 a.m., she was waking up every 30 to 45 minutes. Dude, I'm running on empty right now. Barely any sleep. And now she's deciding to sleep like an angel. She's peaceful and she's quiet. But anyways, I digress. Welcome to part 2 in the best ETF combo video series. In part 1, we focused on aggressive growth and compounding. So ETFs that will maximize that compounding effect, but they're not necessarily the safest choice, right? This video is going to be completely different. It's going on the other end of that spectrum, which means we're going to be shifting gears into the safe and steady side of investing. There's going to be no cryptocurrency in today's video. These ETF combos are built for the busy professional like you. Like if you put in 40, 50, 60 hours a week and you barely have time to keep up with the stock market, individual stocks, this might be for you, especially if your risk tolerance is more on the conservative side where you can't really stomach the volatility of all or nothing type of investments. You might want to pay attention, right? And the best part is, as a dividend growth investor, yes, these ETF combos that we're going to go over, they do pay a modest dividend yield. It's not going to be juicy, but it's enough where you'll have money every quarter or every month, whatever the payout frequency is, to reinvest back into the portfolio and buy more shares. So the first combination, check this out. It's going to be VT and SCHD. So what exactly is VT? It's the Vanguard's Total World Stock ETF. And you might be wondering to yourself, well, hold on, why VT? Aren't you an American? Shouldn't you only invest into American-based companies? Well, think about it like this. With VT, you're essentially investing into everything around the world. So if you're investing into everything, then you have all of your bases covered, right? You're diversified across the board. And ultimately, that means you can sleep well at night, knowing that you have a little exposure into the AI hype movement, and even McDonald's and everything in between. You're investing into China, the US, and those niche startup companies based in Europe, and everything else. And I'm about to make your left nipple lactate, because if we jump on over to the ETF's holdings, check this out. 10,035 different investments comprise VT, and the average PE is a 21.3. And interestingly enough, if you think about all of the different and various publicly traded companies around the world, 23.8% are into the technology sector. 16% are in the financials, 11.4% are industrials. This makes up like the railroads, 3M, Honeywell, those type of companies, consumer discretionary, and the list goes on and on and on. And I think the smallest chunk of change is going to be real estate at 2.5%, usually REITs. And let's see, the biggest holding is going to be NVIDIA, 4% of VT, and then you have Microsoft. It's basically the Mag 7 is what I see, except Tesla is over here on the number 9 spot. And as you scroll down, it's mostly American companies until we hit, 10% right there. And then is there another international company? This, I have no idea what that is, right? So when you invest into VT, you're going to be inherently investing into thousands of companies that you've probably never heard of. Some of them could be the next Mag 7, especially in their economy and in their culture. Like if you are really bullish about Africa, but you don't really know anything about Africa, well, this has your bases covered. Or if you feel the same way about India. But here's the thing, dude. Back when I was getting my undergrad, 16 years ago, dude, everybody was hyping up Africa to being the next boom, the next China, the next growing economy. And the thing is, they've been hyping it up for decades, and I don't know if that's going to come to fruition or not eventually, but if I had to make an educated guess about which emerging market would be the next, like China per se, it's probably India, right? That's what I think. Or maybe Southeast Asia. Think about Philippines, Indonesia. I'm thinking they might have the next economic boom. And I say that because 45 years ago, South Korea used to be one of the poorest countries defined by their GDP and economic output. Now South Korea is number 7 or 8 strongest economy in the world, right? So just because you're at the bottom of the totem pole of your economic production doesn't mean you're always going to stay there. For me, that's why I think VT kind of makes sense, because we really don't know who's going to be the next economic powerhouse. I mean, obviously, I'm an American. I'm super bullish on the American economy. I see eye to eye with Warren Buffett when he says, dude, don't ever bet against America. Like if you're buying puts day after day, hoping that America falls, you're an idiot. You're basically an idiot. You can't go against the American ambition, work ethic, and how almost every single great, influential, and impactful company is literally based in the US. You want to talk about the tip of the spear in the AI movement? It's the American companies. You want to talk about innovation, inventions, patents, whatever it is, dude, it's Americans. And if we jump on over to the dividends tab, it has a 1.7% dividend yield. Yes, I'm rounding up. Are you really going to sit there and unnecessarily correct me, be like, hey, small eyes, it's actually 1.67. Dude, that's the thing that tickles my butthole with a feather. There's people that just leave hate comments. Now listen here, China man, what do you know? And it's like, dude, I'm not even Chinese. And I don't even know why you think calling me Chinese would be an insult. Okay, like, yes, I am East Asian, but dude, chill, okay? Let's stop with the craziness. But 1.7% dividend yield, payout ratio, absolutely sustainable. Dividend growth rate, good, it's decent, 5.3%. The historical rate of inflation is like 3 or 3.5%. So the fact that the dividend growth rate is higher, I like to see that. That means the payout that you get is keeping up with inflation and then some, meaning your payout will keep up with the cost of the dollar devaluing over time. And his partner in this team for the ETF combo that I think is pretty solid is going to be SCHD, the tried and true, the battle tested, the one throughout the ages that I believe will be one of the best dividend growth ETFs. Yes, you can quote me on that. No, that's not financial advice. Yes, your hairline is receding. Dividend yield is 3.8%. Dividend growth rate right here, friends and family, is misleading. It is not 5.8%. Because if you take into account the past 5 years, that dividend has been growing on average. Sometimes it's a little higher, sometimes it's a little lower, but on average, 10.3%. I think that's pretty solid. I mean, think about it like this. Are you ever going to be angry at the fact that at the end of the year, I mean, it's coming up right in December, your boss is going to throw chump change at you and expect you to dance, be like, oh, thank you, sir. Thank you, sir. A 3 or 4% pay raise at the end of the year, it's pretty typical of what happens, right? And you're expected to dance for HR and your manager and be like, oh, thank you so much. But with SCHD, your payout is quite literally growing by 10% year over year. So if your compensation is $100,000 and you get a 10% raise, dude, that's $10,000. So I don't know about you, but I'm not going to be angry at my income payout increasing by freaking 10%. I'm a pretty happy camper. Now, the SCHD ETF, it follows the Dow Jones US Dividend 100 Index, and the criteria and the metrics to join this index I like. However, what I do not like as an investor of SCHD, I mean, just because you're invested into something doesn't mean you have to marry it and love everything about it, right? You can give some constructive feedback and criticism. And when it comes to SCHD, dude, I am not a fan of the breakdown of how they're allocating their holdings right now. You're telling me that almost 19% of the portfolio is allocated towards oil and gas? Yes, that's exactly what I'm telling you. I am not a fan of that, especially given the past 2 years. Dude, the energy sector has been getting smacked, like going 7 rounds of Conor McGregor. They're in a chokehold, or Khabib, right? They're putting them in a headlock, and they think it's the right time to pick it up. And I'm like, gosh, I just don't know about that, right? I do like the consumer staples. I do think the rotation will happen back into them. With energy and oil and gas, yes, the rotation will come back, but it's like, when, right? Is it when the interest rates are falling? Is it going to be next year? Is it going to be in 10 years? Or is it going to dissolve? Is energy going to be something of the past? I don't know. I do know that I'm not bullish, but I do understand the logic and the strategy of why they're putting so much money into oil and gas, because if I click on Chevron, which is one of the biggest conglomerate energy companies, they do everything, right? Upstream, midstream, downstream, they do it all. Look at their dividend profile. I think it makes a ton of sense, right? A 4.4% dividend yield, dividend growth rate 5.6%. There's a lot to like. But what I do not like is their future trajectory, and are they really going to outperform the other sectors? Like, if we think about it, there's more and more Americans that are living longer, right? We're not perishing at age 42 or 45 like we did in the past. We're living to 70 at a bare minimum if you're healthy. Like if you're smoking and you eat like a cow every single night, maybe 65. But for most of us, probably 81, 85. I mean, when you think about the past presidential administration back to back, I think they were both in their 80s. So we're living longer, which means healthcare is going to be a more essential ingredient in keeping us alive. Because when you get up there in that age, dude, things start falling apart. You start pissing yourself, you start needing hearing aids, and genomics and everything else that they're doing in that field is going to become more relevant. So I feel good about the healthcare sector having 15.8%. I feel bullish about industrials. Financials I like. Some people don't like it. I like it. I like everything else. I just don't like how energy has a fifth of the pie. You know what I'm saying? If energy was like, I don't know, maybe 3%, 4%, I would like it better. But that's my critique. But all that to say, I still think pound for pound, SCHD is beautiful. I love him. I think he's handsome. I think his resume looks good. And his track record, phenomenal. So when we think about the breakdown of VT and SCHD as a partnership, what would that look like in a portfolio? So what you see on the screen right now is $10,000 invested into both of them on October 24th of 2011. Now with VT, if you reinvested their dividends, that 10 grand would have turned into 42,900. With SCHD, it would have turned 10 grand into 48,900. So talk smack to me right now. Talk trash to me. Tell me how SCHD sucks when their track record is that phenomenal. Yes, friends and family, for the past year and a half, SCHD's performance has been pooty. It has been the literal manifestation of my baby daughter's poopy diapers. Just trash. You're right. But objectively, are you really going to complain if on average, year over year, your total return is 12%? Be honest, right? Pull your pants back up, wipe 5 times until you see no more brown streaks. Don't lie to my face. You would be happy with a 12% year over year, especially given that it's really safe and conservative. This is not a YOLO. This is not an all or nothing. This is not a speculative ETF. They're investing into the 100 blue chip dividend paying stocks with a really good dividend profile. And to have a really good dividend profile, you usually need really good fundamentals and financials. Now, that doesn't mean that their performance in the stock market is going to be spectacular, as sometimes you have a good dividend profile, but yet you underperform in terms of your share price appreciation. But with SCHD, it's not so much about the share price appreciation, but rather it's about the passive income and the dividends that you get every 3 months. But here's the thing. If you did not reinvest the dividends and you decided to pocket all of the income that you got from 50% of your portfolio being VT and the other 50% being SCHD, well, the aftermath, slightly different, but SCHD is still better than VT. 10 grand would have turned into 36,000 for VT, and the 10 grand for SCHD would be 41,000, and the CAGR, 10.6% for SCHD, 9.6% for VT. I still think that's pretty respectable, but I think it goes to show that if you truly do not need that passive income as a 31-year-old, as a 51-year-old, as a 59-year-old that's still in their working years, and you're still trying to accumulate that wealth and grow your portfolio, it might behoove of you to reinvest back into the portfolio to pick up more shares, to allow that compounding snowball effect to get bigger and bigger, just like your ex-wife's waist. Why pocket the dividends if you don't really have a use for it? Your portfolio definitely has a use for it. It can grow bigger on your behalf to do the heavy lifting. If you take it away from him, he can still compound 10.6% year over year, but it really does take away, right? When you think about the total return for SCHD, 15 years with the dividends reinvested, we're talking about 390%. But if you don't give him his dividends back, 312%. Like, yes, you still would have 4x'd your money, but I don't know about you, but 390 sounds a whole lot better than 312. That's all I'm trying to say. I'm not trying to tell you what to do, but for me and my pea-sized brain that supports the Seahawks, dude, I would rather just reinvest back into my portfolio. And in terms of the ratio of like what percentage should be VT, what percentage should be allocated towards SCHD, I think it really depends on your personal preference. For some of us, we would prefer 80% SCHD, 20% VT. For others, it would go the other way, Pareto's principle. Oh, I want most of the emerging markets to do the heavy lifting in my portfolio, 80% VT, 20% SCHD. I really don't think it matters, but splitting it right down the middle, like you signed a prenup agreement and now you're divorcing, and your ex-wife thinks she's about to get half of the gold stash, but it turns out all of your money is tied to your mother's name, so she gets actually nothing. But regardless, I think 50% into each would be my preference. I'm not telling anyone else what to do, but I think it would make fundamental sense. Now, here's the thing. The goal for the VT and SCHD ETF combo, it's not to chase the highest returns. If you want to maximize that compounding effect, you got to go and watch part 1. Because VT and SCHD, it's to preserve your gains, to protect your hard-earned money, but to also generate a solid, juicy dividend yield, and it's still going to give you steady, modest growth. I mean, we can't really sit here and argue and bicker and complain at a, roughly like 11.5% CAGR between the two of them. That's pretty juicy. That's pretty good. And mind you, this is probably the most modest and conservative way to compound your wealth. Part 1, aggressive. Part 2, dude, I'm not going to go on record by saying this is the most safe and steady because there's no bonds included. And on the topic of bonds, the reason why I don't include them, dude, I'm not a fan of bonds. I would rather just hold my cash in a high yield savings account, a CD, or even a money market fund. Why mess around with bonds is my philosophy. Obviously, I'm an idiot. I don't know what I'm talking about. So I don't think a bond belongs in anyone's portfolio unless you're retired or reaching that retirement age, or if you're looking to do a huge down payment on an overpriced house because a California resident is willing to pay $100,000 above the asking price, then you need that extra cash that's highly liquid. But for most of us, dude, I think bonds are stupid. I just don't think it makes sense, because if you're trying to compound your wealth, you might as well have a money-generating compounding machine to do that on your behalf, VT and SCHD. With bonds, best case scenario, it's going to preserve your capital. Worst case scenario, because of inflation, you're going to lose money. I mean, obviously, if a whale event or a catastrophic situation occurs, yes, VT and SCHD, your portfolio, it's going to drop into the red, but it's most likely going to be temporarily. Obviously, past performance is not indicative of future gains or future performance, but time and time again, whenever the stock market crashes, goes through a recession or a depression, we do tend to rebound and rally back up to all-time highs. Now, with a bond, that would protect you on the downside, but honestly, come on, man. I feel like with VT and SCHD, you'll be all right. So if you had like bonds included, I feel like on a scale of 1 to 10, 10 being absolutely risky, putting all of your mortgage money into a casino slot in Las Vegas, and 1 being so safe that you're not even investing anymore, you're just holding on to cash under your pillow. I feel like this portfolio on the risk scale, probably a 1.5, right? If you were to implement bonds, I feel like it would drop it down to like a 1.2. Not going to make that much of a difference. And for the love of your mother-in-law that nags too much, tells you that you're gaining weight, telling you what to do, and telling you that you're dumb, please avoid meme stocks. And I'm saying that because we're on the topic of safe and steady. Don't even look at meme coins. Yes, sometimes they balloon up in valuation, but more often than not, they crash really hard, and it's probably one of the easiest ways to lose all of your money. Do not fall into the trap of people hyping up 300% potential gains in a week. Dude, like that kind of stuff, it's a unicorn event. For most of us out here, we're better off doing the tried and true, the slow and steady methodology. Going with something that will give you about 11 to 11.5% ROI per year. To me, dude, I would take that any day of the week versus like me having the potential 3xing my money or losing everything in the span of a week. Like, honestly, if you feel ballsy, you might be like, oh, that sounds delicious. But imagine if you lost your entire inheritance. Imagine if you lost your entire portfolio, that $3 million portfolio down to $0. Yes, the potential of having that $3 million turn to $9 million would make your nipples sweaty. But, I mean, think about the other side of that coin, right? It's a coin flip. So for me, SCHD, the tried and true, the overnight get-rich-quick stuff, it just really doesn't appeal to me, and it's gambling. Okay, on this channel, I talk about investing. I don't talk about gambling. I think gambling is stupid. Now, I will say this. I don't think it causes any harm to buy at least, one lottery ticket, every once in a while. Because if you win that and you get like $15 billion, dude, you made it. Okay, but to put like your entire net worth into a blackjack or into a casino slot machine, I think that's stupid. Okay, I think we're kicking a pickpocketer in Paris to the point where they're like vomiting. We should stop. I think we all get the point. Let's move on to ETF combo number 2, and that's going to be a variation of an S&P 500 ETF like VU or SPY. It doesn't really matter what flavor you believe in. Some of us, we like pepper. Others, we like honey. It really doesn't matter. Anything that involves the S&P 500, but also FDVV. FDVV is Fidelity's version of SCHD, except it doesn't follow the Dow Jones Dividend Index, and that's because it's made up of companies that meet specific criteria metrics that the Fidelity team thinks are important, such as the sustainability of the dividend, the company having a large market cap, and more. So if I jump on over to the Holdings tab, about 25% tech space, 21% financials, 12% consumer staples. Consumer staples are stuff that we need to buy day to day in order to sustain life, like groceries, laundry detergent, toilet paper, you get it. 6.5% Nvidia, 5.6% Microsoft, 5% Apple, Broadcom. So FDVV, I'm not going to lie to you right now, I think their strategy and their portfolio holdings against SCHD looks a whole lot better. And the kicker is, the average PE ratio for this ETF is a 19.9. You would think by having such a large chunk of change, 1/4 of the portfolio allocated towards the big tech players, the PE would be like a 30, but they balance it out with the more modest and conservative dividend payers. Ultimately, a 19.9 PE ratio to me, not bad at all. I don't think that's overvalued, considering the S&P 500's average PE right now is a 31. So if we jump on over to the dividend profile, we're talking about a 3% dividend yield and a dividend growth rate, friends and family. I'm not joking. We're cooking here, okay? FDVV, it's a safe and steady dividend growth ETF that I would argue on a good day, they might be able to beat SCHD in a foot race on a good day. But over the long run, I'm going to stand on this tiny little hill, and I'm going to call it right now. This is not financial advice. This is just me being an idiot. I think SCHD will outperform the Fidelity High Dividend ETF, but in the short run, I think these guys are the better ETF. I mean, they truly are, but is that really going to make me want to sell SCHD and jump on over to join the FDVV team? No. I'm not really that kind of guy to just jump ship just because of the recent performance. But actually, I do want to take a look at what is their 5-year dividend growth CAGR. And right now, I'm on a website Seeking Alpha. My goodness gracious, friends and family. So when we think about FDVV, their dividend has been growing at a rate of 10.4% year over year for the past 5 years. Very similar to SCHD. Now, I will say it again. I think this is the better dividend growth ETF for the short term. But over the long run, I'm still going to have to go with SCHD. But as of right now, I do think this is a quite juicy and a beautiful dividend compounder, especially as an ETF, okay? Now, my personal preference when it comes to the S&P 500, I like VU. Some of us, we like SPY. Some of us, we like another variation, but VU to me is just familiar and I'm comfortable with it. Their dividend profile, nothing too crazy, right? A 1% dividend yield growth rate is probably in line with the rate of inflation, actually slightly higher, 3.9%. We jump on over to the holdings tab. This is the S&P 500, right? This is what people refer to as the market, the benchmark, the standard. This is what you're trying to beat. And for VU and the portfolio holdings, the average PE ratio is a 27. However, if you take a look at the index itself, S&P 500, the average PE ratio is a 31.2. Now, the median PE ratio, going all the way back to 1957, has been an 18. So right now, historically, it is kind of pricey, but we're also in the age of the internet where the retail investor is getting bigger and bigger. Like the common person is now able to buy and invest into stocks. Whereas up until 2000 or 2001, you had to call a financial advisor and he would buy the stocks on your behalf. There were trading fees. It was like $14.95 per transaction. Now, I think the barriers have come down. The walls have come crashing down. Anybody can invest. And for most brokerage platforms, it's free. Right? They don't charge you for each transaction. But anyways, all that to say, I think going forward, the PE ratio of the S&P 500 will no longer be around an 18 unless we're on a catastrophic event of like a depression or recession. Then, of course, it's going to drop. But for the most part, if things are just trucking right along, I think the new normal is going to be around a 22 to a 25, in my opinion. Right now, 31, I do think things are a little hot, and that's because a lot of the companies in the S&P 500, they're currently valued at their all-time highs. Like if we jump on over to Nvidia, $186 a share, their market capitalization is $4.5 trillion. So when you take into account all the shares outstanding and you multiply it by their share price, that's a lot, $4.3 trillion. The trading multiple is a 53. right? And if we zoom out and take a look at their total stock market price history, they're at the highest price they've ever been. Okay? And we could do the same for Microsoft, and it's going to be the exact same outcome. They're the most expensive that they've ever been. Their current PE ratio is a 38. So it seems like the Mag 7 and the rest of like the tech space and some of the heavy hitters here, they're at their all-time high valuations. Actually, there is one that is kind of undervalued right now. Let me see if I can pull it up for you. Ticker symbol PG, Procter & Gamble. They're number 24 in VU. I would argue right now they're slightly undervalued. Their PE is a 22. And you think about their past 1 year, the lowest price was a 146.97. They're currently 152. So not everybody in the S&P 500 is overvalued, but for the most part, everybody seems to be trading for a premium. And that's because the markets, and that's because big money, hedge funds, and super investors are feeling pretty bullish about the future. That's what happens when more money pumps into equity and stocks, and they're like, well, I feel good about it. Then the valuations of them go up, and everyone's feeling a little greedy. However, for the past like 2 or 3 trading days, the emotion that fueled the market has been fear. More people were selling than they were buying. I think going back to the ETF combination, I'm so sorry, VU and FDVV would also be a really good combination because it kind of hits all of your bases as well. You get the growth of the AI movement of NVIDIA, Microsoft, Apple, but with FDVV, you also get an insane dividend paying ETF. Case in point, if we take a look at the portfolio analysis of VU and FDVV from January 2017 to September 2025, about a month ago, scrolling down. With VU, your money, $10,000 invested into them in January 2017, it would have grown to $34,000 as of right now. And for FDVV, that 10 grand would have been just shy of $30,000. The CAGR for the S&P 500, we're talking about 15.2%. For FDVV, we're talking about 13%, okay? But something interesting that I do want to call out is during their best year, their best performing 12 months, for the S&P 500, that was 31% into the green. With FDVV, it was 29% into the green. But this is where it gets interesting. During their worst year, during the downside, for the S&P 500, you would have seen a loss 18.1%. With FDVV, the volatility is not as severe because that loss would have been negative 4.1%. So I think that's kind of interesting. When you go with a dividend ETF, when the markets turn red and there's an economic downturn or whatever happened, you don't go as deep into the red as you do with the S&P 500. So I do think they balance each other out. Case in point, if we take a look at their annual returns visualized, the blue is the S&P 500, which is VU or SPY. The teal, lime green, whatever color that is the FDVV. Back in 2022, dude, like the entire Mag 7, the S&P 500 went deep into the red. That's also when it went balls deep into Meta, 3M, and a bunch of other blue chip companies. Negative 18% for S&P 500. For FDVV was negative 4.1%. So I do think they balance each other out because during the worst of times, FDVV will make sure your portfolio doesn't go too deep into the red, but during the best of times, the S&P 500 will help you maximize and capture that share price appreciation. So it seems like in 2023, they outperformed them by a pretty penny. Again, in 2024. And as of 2025, I would say they're pretty neck and neck, right? With VU, we're talking about 14.7% total return for 10 months. I guess we're almost at 11 months. FDVV, we're talking about 14.2%. So what's my takeaway after thinking about these two ETF combinations that I would label as the safe and steady conservative way to grow your money, especially if you're a busy working professional who has no desire to keep up with the stock markets? I think either combination, even mixing and matching, like it's a McDonald's dollar menu. Dude, do you remember when McDonald's value menu used to be $1 across the board? Dude, I miss those days. But anyways, I think you can't go wrong with any combination. The only one where I would hesitate is if you do like SCHD plus FDVV, because then you're missing out on the growth of the S&P 500. But then again, I think the better combination, like the most perfect mix of these ETFs, instead of going with like VU and FDVV, I would argue VU, the S&P 500, and SCHD, and to just call it a day. That's personally what I would do. I'm not telling anyone else what to do. I think VU and SCHD is probably the most perfect blend ETF combination where you can look back on it in 10, 20, 30 years, and to get that 11.5 or 12% CAGR, I think you would be pretty happy. And that just about wraps it up for part 2 in the best ETF combination video series. Now, part 3 that I'm going to be working on as soon as I finish editing and uploading this one is going to be oriented towards the people that are retired, the ones that are looking for passive income to fuel their lifestyle so that they can play pickleball from like 10 a.m. to 2 p.m. and then to go out for lunch at Chili's for that lunch menu special. It's going to be for you guys, okay? And because this video is shorter in duration than part 1, now I'll give you a little story time of everything that went down in the past like week and a half to 2 weeks. So in case you missed it and you're not paying attention, yes, I'm a first-time father. Baby girl came into this world about a week and a half, 2 weeks ago. And everything leading up to the scheduled C-section, it was a pretty smooth pregnancy, right? No complications. Little girl during every single one of our appointments and ultrasounds, very healthy. And we both thought with modern medicine that a C-section would be smooth sailing without any craziness happening, right? But that couldn't be further from the truth because on her birthday, about a week and a half ago on a Wednesday, dude, during the C-section, my wife lost like half of her blood. And she was having a hemorrhage beyond belief, to the point where the doctors that you could see, they were starting to get worried. And I was sitting there like, no, I did not peek over the curtain. I don't want to see her guts and her organs. I was like, dude, is my wife going to die? And to make matters worse, dude, the entire floor of the operating room, there was blood everywhere. And I'm not a guy that's comfortable with blood. I get queasy. Like when someone vomits near me, farts, or has like blood, I'm the first guy to go, who the? Okay? And to see all of that, plus the emotions of the baby being born, I was going through it that day. But I can't complain because I'm not the one getting the operation done, right? So who am I to complain? But anyways, after some quick decision making from the surgery team, they stitched her up and said it was good to go. Or so we thought, right? About an hour and a half to 3 hours later, her condition got worse and worse and worse to the point where she was just about to, you know what I'm saying? Her blood pressure was non-existent. She was basically dead. So they put her into another emergency surgery to reverse damage of what went wrong during the first time they opened her up. And dude, it was a pretty sticky situation that day. I don't want to be a negative Nancy, but the first immediate thought I had was like, dude, I can't be a single father. I have no idea how to raise a child by myself. Like, I need my wife. And after that second surgery, fortunately, she stabilized and she was okay. So I was like, oh, thank goodness. But because the wife went through such a severe and traumatic surgery experience, like back to back on the same day, I took it upon myself to just put the burden on my back. Did you know my name Amos literally means, I think in Hebrew, whatever, to carry a burden? I put it on my back to just take care of her. That way she could just relax, focus on healing and feeding the baby. I took care of everything else. And I'm gonna tell you this right now. When I was changing the baby girl's first diapers, dude, I almost fainted because I had no idea it was not gonna be a little turd. Instead, it's something called like meconium. And dude, it was like black tar, and it was like this much each time. I was like, what the hell is this? Is she an alien? It literally looks like black tar. It almost took me out. It was almost as bad as the blood all over the floor in the operating room. I was like, dude, what the hell? But apparently that's normal, right? A baby expels all of that black tar from her system in the first like 2 to 3 days. Now we're at a point where it looks like yellow Indian curry. Looks a little more normal for a newborn, but dude, the initial diaper changes, crazy. So all that to say, I've been super freaking busy for the past couple weeks, just taking care of everything in the household. But fortunately, my mother-in-law, she's on her way to help us out, and we need that help. Okay, because, dude, it's so freaking hard being a stay-at-home mom. I guess I'm the stay-at-home dad. So I'm going to tell you what, if I'm ever in a position to be a hiring manager again in corporate America, my goodness, will I think highly and differently of a stay-at-home mom that applies to join my team. Because, dude, it takes so much work, effort, dedication, and to run the operations of a household, Dude, it is. If your wife is a stay-at-home mom, dude, you better give her a hug and say thank you. If she's doing all the cleaning, the cooking, and holding down the fort, dude, you have no idea, man. I've only been doing it for the past couple weeks, and I'm exhausted. I'm dying. I can't imagine doing it year after year. But anyways, all that to say, if any of you guys are expecting a child and you have a baby registry, or you're expecting to get married to a man or to a woman or to a pillow, like here in Japan, I think somebody married a pillow of like an anime figure or a cockroach, let me know. Send your baby registry or your marriage wedding registry my way. I can hook it up with a quarter pounder with cheese or something. I'll do something, all right? Because you guys helped me out as well. So all that to say, I love you guys. Stay safe. Good luck in the stock market. And if you want more story times, let me know, because I know there's a small minority of people that hate when I talk about my personal life. They're like, dude, shut up. Just talk about the numbers. I don't give a crap about. I know there's people like that. So if you do want to hear more story times, let me know. But I'll be working on part 3, and I'll talk to you really soon. Peace.